All right, what's up, guys? So, I made a video earlier this year in January about the current state of the markets and how I was kind of approaching and working my way through them. And it worked out pretty well. Some of the predictions were pretty much on point. Um, and I saw some things from Europe, from the ECB, the European Central Bank, some data that came across. My Twitter feed, and I thought I'd make a video about it because it seems kind of alarming. It seems like somewhat a similar situation to earlier this year in the U.S., but a little bit more alarming just because there doesn't seem to be as much of a reaction as the U.S. did. Even though the U.S. was much late in the reaction, much later than they should have been, the EU just seems to be completely oblivious to what's coming up, and I think this video will be helpful for some people just to at least digest and kind of come up with a plan for how they want to approach it. So I'm going to first explain what happened with the U.S., what the U.S. went through for the past 6 to 8 months, and then we'll go into the EU. So November last year, we had a really large CPI print of 6.8%, which caused the Fed, the U.S. Federal Reserve, to reverse its course and set up a timeline to raise rates and stop quantitative easing. Then we had our first rate hike in March of 2020, went from 0.08% to 0.2%, so doubled. Nothing crazy though, but it did double in a sense, and that was the first initiation of the rate hike timeline. Then we had the end of QE about 2 months ago in May, and we stopped buying about $80 billion worth of mortgage-backed securities and treasury bonds to put on the Federal Reserve's balance sheet. And then just a couple weeks ago and last week, we went with a more aggressive rate hike, one of the largest rate hikes, I believe, the past decade. It was a 0.75% interest rate hike, and we also started quantitative tightening, which is selling assets off of the U.S. balance sheet into the public markets to withdraw capital and basically make money more scarce. And this is all in order to hopefully fight inflation. So what happened from that? Basically, all major indices are down at least 20% across the board. I believe the NASDAQ is down 30%. And that's just an average. The indices are kind of a makeup of a bunch of companies. So if you really look at more like growth, more speculative assets such as crypto, such as technology companies, EV startups, things like that, those companies can be down anywhere from 50 to 90%. So large shock across the board. Definitely the market went into a risk-off mode. And also, with all this taking place over the past 8 months, with all these factors in place, CPI still has not slowed down. I believe we hit 8.6% as well as the EU. And it doesn't seem to be slowing down. I believe the main reason is because of energy cost from the war and things of that sorts, and other aspects too. I'm not going to say it's just the war, but we took steps way ahead of time and still are dealing with this to the day. Now, what's the upcoming issues with the EU? Sort of the same boat. So we have the inflation rate is at 8.6% versus 2% year-over-year target. The interest rate is actually at negative 0.5% with plans to raise up 0.25% in September. So that still means we're going to have a negative 0.25%, but it's the first rate rise in 6 years, I believe. We have the end of QE, which quantitative easing is going to be ending, I believe, last week. But there is no plan of quantitative tightening, which is selling assets off the balance sheet. And then we also have the energy shortages continuing. So let's dive into each of these with just some quick diagrams showing some data. So here's the inflation rates. So we have COVID marked out here below. July, basically COVID started the second quarter or second half of July of 2020. We had negative interest rates or inflation rates, but we very quickly rose to now at 8.6%. It doesn't seem like there's an inflection point at the current moment. Inflation is just pretty much rampaging on pretty quickly. And here are the interest rates. So it doesn't show it going negative for some reason, but rates have been negative since 2016 from this chart. And with that being the case, basically we're going to have the first rate hike since 2016, which can cause a shock to businesses relying on borrowing to survive, businesses with high burn rates. And we're now going to be entering this paradigm where savings will start increasing now because there isn't a penalty to do so. So right now, because interest rates are negative, when you're leaving money in the bank account, you're actually losing money due to some sort of fee. I don't know what exactly it's called, but this is just from what I read online. Please don't hold me to it. I don't actually live in Europe, but it seems like people are actually losing negative 0.5% per year on their money in the bank. So this is incentivizing people to, invest, loan out, spend, whatever the case is, basically incentivizing people to get rid of money. Where if we start entering a positive interest rate environment, it's going to start incentivizing people to save, and it's going to start starving the economy of the capital it's been used to for the past 6 years. All right, so to dive on, here is the balance sheet. So basically from 2020 on, you can see there's a very drastic jump, and the balance sheet basically doubled over these past 2 years. And here's the money supply. It didn't grow as drastically as the balance sheet, but it still went from about 2.5 trillion to a little less than 15 trillion in the past 2 years. And one thing I want to bring up with the balance sheet is the major buyer is leaving the marketplace. So basically, the ECB has been buying assets since 2015, and then they ramped up the asset buying when COVID took place. So with that being the case, the markets just had a buyer of MBSs and of bonds ever since 2015, basically over 7 years. And with that now leaving the marketplace, I'm sure it's going to cause some sort of shock to the banks relying on them purchasing the assets. And then majority of assets are actually owned by the ECB. So I'll show you back again. We have the money supply, which is at 15 trillion. And then we have the balance sheet, which has a valuation of 8.8 trillion. So over half of all assets are owned by the ECB. And if the ECB were to enter a predicament where they need to start quantitative tightening, which is selling assets off their balance sheet, I don't know if the markets will actually be able to support that just because of the sheer quantity that they have. I mean, obviously they can taper it in an extent, but I mean, you're talking like 50% of all assets are owned by them. So I don't know how much they can push out, a couple percent, maybe 10%, maybe. But when you get in the double digits, that's going to start getting pretty hairy for financial institutions. All right, so two more things I want to bring up is just the Euro area's average debt to GDP. So it's kind of a common known thing. Once debt to GDP extends past 100%, it's usually sort of a red area where there starts to get some hairy situations start to take effect. And we can see we're hovering around 95%. Debt to GDP at the moment, and because each of the countries are actually individualized, some of them are more than others. So if you look at Greece is 205% debt to GDP. Italy's 155, Portugal 133, and so forth. So you have a large amount of countries that are actually above the average. You have some that are below, obviously, as well, but these will hurt these countries as businesses start to shrink up and not be able to spend as much money on taxes. So to summarize, basically, inflation's still growing very drastically. If you look at the U.S., we started sort of tackling inflation still late in the game, but we started tackling it, around the 6.5%, CPI print, and we are still dealing with, higher inflation prints going forward, even though we have mortgage rates that are like 6%. We have, a lot of markets that are down, financial markets that are down. We still have this issue persisting in the economy. Interest rates, one of the things that can happen with interest rates that sort of brings some red flags is this is the first time in 6 years that rates are going to start taking effect, obviously with the first one in September, and I'm assuming they're going to be doing many more as inflation is going to keep persisting over in the Eurozone. And this will cause over-leveraged countries, so those countries with extra high debt to GDP, and business models that rely on over-leveraging to begin failing. And this can also cause like a domino effect in some extent where, countries maybe stop getting as much tax money as they need, businesses aren't allowed access to as much money as they need anymore, and it doesn't have to be like one huge blow up. It could be a bunch of little blow ups that can cause a trickle effect throughout the economy. Another thing too, the ECB is exiting the market, so it's the first time they're stopping purchasing of assets since 2015. That will cause some sort of shock to the system. And the energy crisis, I didn't really touch on this much, but I think it's a pretty obvious thing. So with the EU areas being a net importer of energy, they're not energy independent anymore because of nuclear and all those other sort of things they've shut off. They have to rely on imports from other countries, such as Saudi, and I believe they're still getting it from Russia, but they're kind of like finagling it through different zones. They're trying to get around their own rules. And with that being the case, I believe that this can also continue on and cause larger inflation prints, especially with winter coming up, and if the war persists on and the tensions continue rising. All right, so I don't really know much about the European markets, so I really don't want to say like this is what I would do, this is how I would approach the situation, because I haven't been through it, so I don't really know. But with that being the case, I still want to point out that some of these markets are down, still pretty decently. So if you go over the year to date, 16% for the CIC, a little less than 20% on the DAX, and about 15% on the Euronext. So the markets are still down pretty decently. They're still down double digits year to date. And even with that being the case, I still think they have a long way to go with all these issues coming up. So maybe potentially buying some puts or shorting some of these indices could be an option. Maybe finding some very over-leveraged companies that have a lot of debt, buying some puts on those. Maybe just buying puts to cover your investment fund if you do have one, just to make sure that it doesn't get wrecked over the coming year or so. But that is probably what I would pay attention to coming into all these turbulent times, all these four major things I'm looking at: the inflation, interest rate increases, the ECB tapering, or not tapering, but stopping their QE and potentially tapering down the road, which I believe is going to be necessary, and the energy crisis persisting on. So that being the case, thank you guys for watching this video. I hope it was helpful in some way. It was very eye-opening to me, as I think the European markets will somewhat, all their turbulent times will sort of bleed over to the US, just like it did back in 2019, 2018. And kind of helps with my thesis on when I think it'll be a good time to buy into the market, which I do have a video on that if you want to take a look. I made it about last month. Some things have changed, but not much. And with that being said, thank you for watching. Have a good rest of your day.